Silver's revenge from 78 to 87 in 48 hours. The comeback that broke Wall Street February 3rd, 2026. Silver is climbing, $78 to 87 in just 48 hours. Wall Street called it impossible. Institutional traders called it irrational. But something far more dangerous is happening beneath the surface. The worst precious metals crash in 45 years, followed by the fastest recovery in modern history. This isn't a bounce. This is a warning. What the financial establishment doesn't want discussed. What the data is screaming. What every strategic decision maker needs to understand right now. The question isn't whether silver recovered. The question is, what breaks next? Welcome to Owen Ag, where we examine the economic signals others choose to ignore. If this analysis matters to your strategic thinking, if understanding market structure is part of your responsibility, we'd appreciate your subscription. Consider it a professional courtesy, the way experienced colleagues share important research. And before we proceed, we're curious, from which city or country are you following these developments? Your perspective adds context to this global situation. Share that in the comments below. Now, let's examine what actually happened in those 48 hours and why it matters far more than the headlines suggest. Thursday, January 30th, 2026. The precious metals market was celebrating. Silver had touched $120 per ounce. Gold had reached $5,600. Traders were euphoric. Institutional money was pouring in. Leverage was at historic extremes. Everyone believed the rally would continue. They were about to learn a brutal lesson. Friday morning, January 31st, Asian markets opened. Something shifted. Chinese speculators, the same buyers who had driven prices higher for months, suddenly reversed course. They weren't buying anymore. They were selling aggressively. The first hour showed modest declines, nothing alarming. Silver dropped from $115 to $110. Traders called it healthy profit-taking. A normal correction after an extraordinary run. They were catastrophically wrong. By midday in Asia, the selling accelerated. Silver crashed through $100. Then 95, then 90. The speed was unprecedented. Professional traders watched their screens in disbelief. Positions that had been profitable for months were suddenly underwater. Then Europe opened. The panic intensified. Margin calls started hitting. When a trader uses leverage, borrowed money to amplify their position, they must maintain minimum account balances. As silver plummeted, those minimums were breached. Brokers issued margin calls. Traders had minutes to deposit more cash or face forced liquidation. Most couldn't meet the calls. Their positions were automatically closed at whatever price the market offered, which meant more selling, which pushed prices lower, which triggered more margin C. Self-reinforcing cascade of forced liquidation. Silver collapsed to $85, then $80. The losses were staggering. Traders who had been millionaires on Thursday were wiped out by Friday afternoon. But the nightmare wasn't over. New York opened. Wall Street traders arrived expecting volatility. What they encountered was carnage. Silver was in free fall. Algorithmic trading systems, computers programmed to follow trends, detected the breakdown. They began selling automatically. Millions of ounces dumped into the market in seconds. The infrastructure couldn't handle it. Trading platforms froze. Order execution delayed. Prices displayed on screens were minutes old. Traders were operating blind. Panic turned to chaos. By noon, Eastern Time, silver had crashed to $78 per ounce, from $115 to $78 in less than 24 hours, a 31% decline in a single day. The worst precious metals crash in 45 years. Gold suffered similarly, plummeting from $5,200 to $4,400, losing $850, an unprecedented move for the traditionally stable metal. Mining stocks were devastated. Companies that extract silver from the ground saw their share prices collapse. Some fell 40% in hours. Decades of shareholder value erased in a single session. Exchange-traded funds, investment vehicles that track precious metals prices, experienced catastrophic outflows. The ProShares Ultra Silver ETF, which uses leverage to amplify returns, lost over 30% of its value. Investors were fleeing. The trading floors fell silent. Veteran traders, people who had survived decades of market turbulence, sat stunned. They had never witnessed anything like this. The speed, the violence, the totality of the collapse. Analysts scrambled to explain what happened. Some blamed Chinese speculators, claiming their sudden exit triggered the cascade. Others pointed to the crowded trade. Too many investors positioned the same way, all forced to exit simultaneously. Technical analysts noted the extreme leverage when everyone borrows money to bet on rising prices. Even small declines can trigger massive liquidations. Robert Gottlieb, a former precious metals trader at JPMorgan, Later summarized it simply: the trade was way too crowded. Too many speculators, too much leverage, all betting the same direction. When the reversal came, there was no escape. By Friday's close, the damage was calculated. Billions of dollars in value vanished. Hedge funds reported massive losses. Retail investors saw their accounts decimated. And the precious metals bull market, which had run for months, appeared finished. Market analysts declared it over. The rally had been excessive, driven by speculation rather than fundamentals. The crash was inevitable. Silver would continue declining. Gold would follow. They recommended selling, cutting losses, moving to safer assets. As trading ended Friday, as the screens went dark, as traders left their desks in shock, one question dominated every conversation. Was this the end, or just the beginning of something far worse? Monday would provide the answer, and Monday would bring its own nightmare. Monday morning, February 2nd, 2026. The sun rose over Shanghai, but there was no light in the precious metals market. What traders hoped would be stabilization became extension of the nightmare. Silver opened at $76, immediately dropped to $73. The weekend had solved nothing. Fear still controlled everything. Sellers were still overwhelming buyers. By midday, Asian session, silver touched $71 per ounce. This was the moment that would define everything that followed. $71 held, not because of hope, not because of optimism, but because something fundamental shifted. Physical buyers, people who actually use silver, manufacturers who need the metal for electronics, for solar panels, for industrial applications, they stepped in. These weren't speculators with leverage. These were corporations with cash, buying real metal at what they calculated were bargain prices. The price stopped falling. For 3 hours, silver traded between $71 and $73. Flat, no dramatic moves, just grinding stability. To exhausted traders, this felt like mercy. They had no idea what was coming next. Tuesday morning, February 3rd, 9:30 a.m. Eastern Time, New York trading floors buzzed with nervous energy. Traders gathered around monitors. Coffee went cold in paper cups. Everyone asked the same question. Would Tuesday bring another collapse? Or had the market finally found its floor? The opening bell rang. Silver opened at $79. Then something extraordinary happened. It didn't drift higher. It didn't cautiously test resistance. It exploded upward, like a compressed spring suddenly released. 79 became 81. 81 became 83. Within the first hour, silver had jumped to $83 per ounce. Traders who had spent 3 days watching their positions disintegrate suddenly saw green on their screens. But this wasn't relief. This was confusion. And what was happening? Who was buying? And why now? The buying continued. By midday, silver crossed $85. Gold surged past $4,900. These weren't small moves. These were violent reversals. The same intensity that destroyed the market on Friday was now rebuilding it on Tuesday. But the source of buying was different. Retail investors, ordinary people who had watched silver collapse from 115 to 71, finally saw their opportunity. They had been waiting, sitting on cash, waiting for the dip. Now they were buying aggressively. Industrial users who had delayed purchases, hoping for lower prices, suddenly panicked. What if 71 was the bottom? What if prices climbed back to 100? They needed physical metal. They bought. Then the professionals returned. Hedge funds that had been forced to liquidate on Friday, that had survived the margin calls, began rebuilding positions. They had capital. They had conviction. They bought. Investment funds that had reduced exposure during the panic saw the stabilization at 71, interpreted it as a signal. They re-entered. They bought. Even some Chinese speculators, the same traders who had triggered Friday's collapse, were reportedly buying back in. They had sold at 110, 105. They were buying at 75, 80. The trade had flipped. The algorithmic systems detected the shift. These computer programs that had sold automatically during the collapse were now programmed to buy the bounce. High-frequency trading algorithms, executing thousands of trades per second. All buying, pushing prices higher. The technical picture had transformed completely. Charts that showed catastrophic breakdown on Friday now displayed powerful reversal patterns. Traders who follow technical analysis, who make decisions based on chart patterns, saw bullish signals everywhere. They bought. Mining stocks led the charge upward. Fresnillo, the world's largest silver producer, jumped 4.6% in London. Endeavour Silver surged 9.2% before U.S. markets even opened. Kerr Mining added 9.4%. Hecla Mining and First Majestic Silver both climbed over 8%. The money that had fled on Friday was rushing back on Tuesday. Exchange-traded funds told the story clearly. The ProShares Ultra Silver ETF, which had lost 30% on Friday, exploded 16.1% higher on Tuesday. The iShares Silver Trust gained 8.6%. Even conservative gold ETFs posted solid gains. By market close Tuesday, silver stood at $87 per ounce, from 78 to 87, in just 2 trading sessions. A 22% gain in 48 hours. The same market that had crashed 31% had recovered 22%. The velocity matched, the intensity matched. Only the direction had reversed. Analysts struggled to explain it. Christopher Forbes from CMC Markets called it a classic air pocket after an extraordinary run. He argued the crash was profit-taking combined with dollar strength, not a fundamental breakdown. Forbes maintained that gold could revisit recent highs if the Federal Reserve continued easing. Jose Torres from Interactive Brokers saw it differently. He believed the Kevin Warsh nomination, a new Federal Reserve appointment, had revived confidence in central bank independence. The fears that drove metals to record highs were unwinding. But here was the critical question that nobody could answer with certainty. Was this a genuine recovery, or just another spike in a broken market? Daniel Ghali from TD Securities offered insight. He noted that the bulk of forced selling, the quantitative fund deleveraging, the leveraged ETF liquidations, the trend-following algorithms, had already hit the market. The cascade had run its course, and what remained were holders with conviction, not traders with margin calls. The weak hands were gone. The strong hands were accumulating. But if the recovery was real, if the worst was truly over, why were major institutions still predicting even higher prices? Why was Citigroup still projecting silver at $100 by March? Why was JPMorgan forecasting gold at $5,000, even $6,000? What did they see that the market was missing? Wednesday morning, February 4th, 2026, in glass towers across Manhattan, London, Hong Kong, something peculiar was happening. The analysts were unchanged. After witnessing the worst precious metals crash in 45 years, after watching 31% evaporate in hours, after seeing billions in market value destroyed, the major banks hadn't altered their forecasts, not by $1, not by a percentage point, not at all. This was unusual in normal market conditions. And when catastrophic events occur, institutions revise, they adjust, they hedge their predictions, but not this time. Citigroup's research desk published their updated precious metals outlook, silver target $100 per ounce by March 2026. Bull case, $110 in the second half of the year. The same numbers they had published before the crash. UBS maintained their gold forecast, $4,800 to $5,000 per ounce by December 2026. Gold was already trading at $4,900, already within their range, despite everything that had happened. Bank of America held firm, $65 silver target, 56.25 average. They issued a statement explicitly declaring the crash reflected temporary dislocation, not fundamental deterioration. Temporary dislocation, as if losing 31% in a day was merely inconvenient. JPMorgan Global Research went further. Their latest forecast called for gold at $5,000 by Q4 2026, with $6,000 possible longer term. They projected central bank and investor demand to average 585 tons per quarter throughout 2026. These weren't small regional banks offering optimistic speculation. These were the largest financial institutions on Earth. With research teams analyzing every data point, with access to information retail investors would never see, why were they so confident? The answer lay in 3 observations, 3 pillars of analysis that suggested something the market wasn't seeing. The first pillar, the physical market never crashed. While paper prices collapsed on Friday, while electronic contracts were liquidated by the millions, while trading screens showed catastrophic numbers. The physical market told a different story. Shanghai, the world's largest physical gold exchange, was showing 12 to 13% premiums throughout the entire crash. Buyers in China were paying 12% more than the official paper price to secure actual metal. If the crash was real, if silver's value had genuinely collapsed, why were Chinese buyers paying premiums? Tokyo's secondary markets showed 60% premiums, 60%. People in Japan were willing to pay $112 for silver, while paper contracts traded at $70. Dubai maintained 40% above spot pricing. Middle Eastern buyers, who traditionally hold physical wealth, weren't selling. They were buying, at prices far above the official market. This was the divergence nobody could explain. Paper said silver was worth $71 at Monday's low. Physical buyers were paying $95, $100, $112. Dominic Spurzl from Heraeus Precious Metals, one of the world's largest precious metal refiners, confirmed it. Retail demand for physical bars and coins strengthened Monday morning as prices stabilized. Real buyers, with real money, were accumulating actual metal, not paper contracts, not ETFs, not derivatives. Physical silver that could be held, stored, possessed. This is the opposite of what happens in genuine bear markets. When assets truly lose value, physical demand disappears, premiums collapse, sellers flood the market. That didn't happen. The second pillar, the supply deficit, hadn't changed. Friday's crash didn't create new silver mines. It didn't increase production. It didn't solve the fundamental imbalance. Silver was facing its fifth consecutive year of market deficit. Industrial consumption continued to outpace mine supply. Every single year, more silver was being consumed than produced. The photovoltaic sector, solar panel manufacturing, required silver. Electronics manufacturing required silver. Electric vehicle production required silver. These industries weren't shutting down because paper prices crashed for 3 days. The factories in China, in South Korea, in Germany still needed the metal, still purchased it, still consumed it. And here was the critical detail most traders missed. China had strategically reclassified silver as a critical material. In 2024, the Chinese government designated silver essential for national security. Export restrictions were implemented. Global supply chains fragmented. That policy didn't reverse on Friday. Western buyers still couldn't easily access Chinese silver. Chinese buyers had no incentive to sell domestically controlled supply to foreign markets at paper prices. The physical metal was becoming geographically trapped. Supply in China stayed in China. Supply in the West stayed in the West. And Western supply was insufficient for Western demand. The third pillar, the crash, was entirely technical. This was perhaps the most important observation. Daniel Ghaly from TD Securities examined the liquidation. He calculated that quantitative fund deleveraging, leveraged ETF unwinding, trend-following algorithm selling had already hit the market. The forced selling was complete. What did this mean? It meant Friday's crash wasn't caused by fundamental reassessment. It wasn't because silver's industrial value declined. It wasn't because supply increased or demand decreased. It was because too many speculators, using too much leverage, were positioned identically. And when volatility spiked, they were all forced to exit simultaneously. Robert Gottlieb, the former JPMorgan precious metals trader, explained it perfectly. The bottom line is that the trade was way too crowded. The crash wasn't about silver's value declining. It was about trader positioning, unwinding. Jia Zheng from Shanghai, Suzhou, Juying Investment Management, confirmed the dynamic from China's perspective. Chinese traders who had reliably driven prices higher flipped on Friday. Most buyers sitting on profits had one foot out the door, ready to exit at any moment. But here was the revealing detail. Those same Chinese speculators were reportedly buying back in. The cohort that triggered the cascade could now underpin the recovery. If dip buying from China emerged as strongly as the selling, prices could snap back faster than they fell. The institutions saw this. They understood that Friday's event was a liquidation, not a valuation change. The fundamentals, the supply deficit, the industrial demand, the physical market premiums, the geopolitical supply fragmentation, none of it had changed. What changed was trader positioning, and now, just after the liquidation, positioning had reset. The weak hands were gone. The leverage was reduced. The crowded trade was unwound, which meant, from an institutional perspective, the conditions were now healthier for the next leg higher. But there was something else, something the banks weren't saying publicly, something that made their confidence even more remarkable. The crash had revealed something about the market itself, something about its structure, about how it actually functions in 2026, and that revelation was more important than the price movement. Because what the crash exposed suggested the precious metals market wasn't just volatile, it was fundamentally broken. Thursday morning, February 5th, 2026, the recovery was holding. Silver stabilized near $87. Gold maintained $4,900. Volatility had compressed. The panic had subsided. But something had changed permanently. Market participants, from retail traders to institutional desks, were beginning to understand an uncomfortable truth. The precious metals market in 2026 wasn't functioning normally. Nikki Shields from MKS PAMP, one of the world's largest precious metals trading houses, stated it directly. I would label the precious markets as broken given unheard of volatility. Broken. Not temporarily disrupted. Not experiencing unusual conditions. Broken. Alessandro Tomei, a senior commodities analyst, offered crucial context. The fundamentals don't explain a commodity being up 200%. The way silver is behaving is exaggerated. It's a series of disconnects. The market is broken. He identified the source: excess liquidity sloshing through global markets. When equity valuations become stretched, when bond yields offer minimal returns, when traditional assets appear overpriced, that liquidity searches for alternatives, gold and silver increasingly served as parking places for that capital. But here was the problem. Guy Wolf from Merrick's explained it. Markets such as silver and platinum are a fraction of the size of gold or major equity benchmarks. The recent influx of speculative capital is having an outsized impact on prices. Small market, massive capital inflows, limited production capacity. This created a dangerous feedback loop. Limited supply meets enormous liquidity. Prices spike, speculators notice. They enter with leverage. Prices spike further. More speculators arrive. More leverage deployed. Prices reach extreme levels. Then something triggers profit-taking. A news headline, a policy announcement, a large seller, doesn't matter what. Leverage unwinds violently. Prices crash. Panic spreads. Forced liquidation accelerates the decline. Prices overshoot to the downside. Physical buyers step in at lower levels. Prices stabilize, begin climbing again. The cycle repeats with increasing amplitude. The market had just completed one full rotation of this pattern. Thursday, January 30th. Euphoria, record highs, leverage at extremes. Friday, January 31st, panic, liquidation, worst crash in 45 years. Monday, February 2nd, capitulation, intraday lows, maximum fear. Tuesday, February 3rd, stabilization, recovery, bargain hunting, one complete cycle. In 5 trading days, and now the market was entering the next phase. But which direction would it take? 3 scenarios remain possible, each with different implications, each requiring different strategies. Scenario Alpha, extended consolidation. This was the consensus view among institutional traders. Prices stabilize in current ranges. Gold trades between $4,500 and $5,000. Silver holds between $75 and $90. Volatility compresses as the market digests the shock. Timeline, 3 to 6 months. Probability, highest. This scenario wasn't exciting, but it was most probable. Markets historically spend more time consolidating than trending. After extreme moves in both directions, sideways action allows new equilibrium to establish. For traders, this meant range-bound strategies. For investors, this meant patience. Scenario Beta, secondary collapse. This scenario required external catalysts. If economic data deteriorated sharply, if margin calls spread to other asset classes, if the dollar strengthened aggressively, precious metals could face renewed selling pressure. Gold might test $4,000. Silver could fall to 65 or 70. But this required genuine economic crisis, not just volatility, actual deterioration in fundamentals, corporate earnings collapse, banking system stress, sovereign debt concerns. Probability conditional on external shocks. The indicators to watch were clear: physical premiums compressing below 5%, COMEX registered vault inflows, Chinese strategic reserve liquidation. Any of these would signal genuine demand weakness. If Shanghai premiums fell below 5%, it meant physical buyers were disappearing. If COMEX vaults saw major inflows of registered metal, it contradicted the shortage narrative. If China dumped reserves, something worse was coming. Scenario Gamma, the bullish resolution. This was the tail risk scenario, low probability, catastrophic impact. Physical market reality overwhelms paper market pricing. Shanghai premiums expand beyond current levels. COMEX vaults continue draining. Industrial buyers panic about supply constraints. Paper markets lose credibility, forcing prices to adjust to physical replacement costs. In this scenario, independent analyst forecasts of $150 to $170 silver materialize not through gradual appreciation, through violent short squeeze as buyers compete for limited supply. This was the scenario that kept risk managers awake at night. Because if it unfolded, it wouldn't be gradual or orderly. The bullish confirmation signals were specific. Delivery failures at COMEX, vault drain acceleration, premiums expanding, Chinese buying accelerating despite elevated prices. Most critically, watch China's behavior. If Chinese buyers continued accumulating regardless of price, it confirms strategic accumulation. National priority, not investment speculation. Nations don't speculate. They secure resources essential for economic security. But regardless of which scenario materialized, one truth had become undeniable. The precious metals market functioned differently than traditional analysis suggested. The relationship between paper prices and physical reality had fractured. Electronic contracts traded at one price, physical metal changed hands at another. Sometimes the gap was 5%, sometimes 15%, sometimes 40%. This divergence couldn't persist indefinitely. Either paper prices would rise to meet physical replacement costs, or physical premiums would collapse as demand weakened. One market would force the other to adjust. For strategic decision makers, for institutional participants, for anyone with significant exposure, several principles emerged. First, respect volatility. Position sizing mattered more than directional accuracy. Friday proved that being right about long-term direction was irrelevant if you couldn't survive short-term volatility. Traders who correctly predicted higher prices still got wiped out, because they used leverage they couldn't maintain through the drawdown. Second, distinguish between paper and physical. For long-term wealth preservation, physical metal in direct possession cannot be margin called, cannot be force liquidated, cannot disappear in database errors. The premiums paid for physical over paper seemed expensive, until Friday showed why they existed. Third, monitor the right indicators. Don't just track paper prices. Watch physical premiums in Shanghai, Dubai, Tokyo. Follow COMEX vault inventories. Pay attention to central bank buying. Track industrial demand data. These fundamentals moved slower than paper prices, but ultimately determined direction. Fourth, prepare for anything. The market demonstrated capability for moves previously considered impossible. 31% crash, 22% recovery, and 4 trading days. Have contingency plans for further downside, for explosive upside, for extended consolidation, and maintain flexibility to adapt. Because the precious metals market in 2026 wasn't for those seeking steady, predictable returns. It wasn't for those who panic when positions move 10% in a day, but for those who understood the fundamental forces, who respected volatility, who could separate signal from noise. Enormous opportunities existed. As February progressed, as the market stabilized, as participants processed what had occurred, one certainty remained. The crash was real. The pain was real. The margin calls were real. But the fundamental drivers that pushed gold to 5,600 and silver to 120 hadn't disappeared. They had been temporarily obscured by massive leverage deleveraging. Whether recovery continued to new highs, whether another leg down materialized, whether consolidation extended for months, the precious metals story in 2026 was far from over. In fact, based on what the institutions were seeing, based on the divergence between paper and physical, based on the supply deficits and geopolitical fragmentation, it might have just begun. The question wasn't whether volatility would return. The question was, when it returned, would the market survive it, or would the next cycle break something that couldn't be repaired? Time would provide the answer. But those who understood what happened in these 48 hours would be prepared when that answer arrived.